Welcome back, everyone. Today, we're diving into a really fascinating explainer. We're going to unpack some incredibly provocative arguments that have been making serious waves in the finance space lately. Specifically, we're looking directly at the hidden tax series presented by CPA Brian. He's issuing some stark warnings against central bank digital currencies, or CBDCs. You know, the series presents this very specific, almost cinematic vision of our financial future, and we're going to use our time today to map out exactly how he builds that case. We'll explore the math, the proposed mechanisms, and the underlying motives presented in the source material so we can fully understand the argument he's making. Okay, let's dive right into this. The series, well, it doesn't waste any time easing us in. It hits us right out of the gate with this powerful image pointing to the year 2026 and a massive push for a digital dollar. Just imagine a world where the IRS sees every cup of coffee you buy before the receipt even prints. Brian describes this push not as some fancy tech upgrade or a way to make our lives easier, but as the establishment of the ultimate hidden tax on our privacy and financial freedom. By using that everyday example of just buying a coffee, the concept of total financial visibility feels, well, immediate, right? It feels deeply personal, setting the stage for a scenario where there are absolutely zero blind spots left for the consumer. Which brings us to Section 1 of his manifesto, the privacy warning, and the threat of total IRS visibility. Let's look at how the public messaging differs from reality here. So a pretty stark dichotomy is drawn here. On one hand, you've got the digital dollar being marketed as digital convenience, a fast, easy, frictionless way to pay for things. But beneath that surface, the series argues that this convenience is actually a smokescreen. The real objective, total visibility and tracking. The core premise is that the IRS wants to monitor literally every single nickel you spend, framing a digital dollar not as a helpful tool for the consumer, but as the ultimate tracking mechanism for the state. And that leads us right into Section 2, programmable currency and automated compliance. If total visibility is the goal, how exactly is the government achieving it? Well, the linchpin of this entire argument is the concept of a central bank digital currency as a programmable digital currency. Because the currency is essentially just lines of code, it can be engineered for automated tax compliance. Think about that for a second. This means tax collection happens instantaneously, literally before the money even hits your bank account. Writing from his perspective as a CPA, Brian argues that this programmability fundamentally changes the entire relationship between the citizen, their money, and the tax authority. And this brilliantly illustrates his next point. This automated taxation isn't just about collecting standard income tax faster. The author claims it's specifically designed to kill your ability to legally minimize your tax burden. The series calls out strategies that people use to legally navigate the system right now, like small business deductions and the 14-day rental rule. Now, that rule currently allows homeowners to rent their properties completely tax-free for up to 2 weeks a year. But a programmable currency would mathematically eliminate those strategic gray areas and all that careful planning taxpayers currently rely on. It enforces this rigid, inescapable compliance that strips away these legal loopholes entirely. So why go to such incredible lengths for automated control? Well, that brings us to Section 3, the $39 trillion motive, and a government that is completely desperate for revenue. $39 trillion. That is just a staggering amount of national debt, and it's cited here as the primary catalyst for the digital dollar. With debt this massive, the government is described as utterly desperate for revenue to service it. In this view, the aggressive push for CBDCs isn't some futuristic tech experiment. It's a direct, desperate response to a specific, very real debt crisis. The idea is that a system ensuring maximum revenue extraction is needed, and a programmable currency is presented as basically the only way to mathematically guarantee that extraction. Building on that desperate need for cash, the author warns this technology could unleash some extremely severe financial controls. A CBDC wouldn't just track your spending, it could potentially allow the monitoring of unrealized gains. And even more provocatively, it suggested the government could literally force spending to stimulate the economy. Seriously, imagine your currency being programmed with an expiration date, forcing you to spend it rather than save it. This entire system is referred to in the series as a mathematical cage disguised as a digital wallet for the American people, which really illustrates just how deep this control could supposedly go. Finally, we reach the last part of our thematic deconstruction, Section 4, the financial fortress and how to protect your assets. If this digital trap really is coming in 2026, what are the countermeasures? The author's specific call to action is all about stepping outside of that programmable system. To protect your financial fortress, the series strongly recommends owning hard, tangible assets that the government absolutely cannot code or print, specifically physical gold and land. The argument is that by moving your wealth into these unprogrammable categories, you avoid becoming a victim of the digital trap. And, as a final defensive action, subscribing to the Hidden Tax Service is recommended so you can continuously learn how to keep the math in your favor as this whole landscape evolves.